Inflation has slowed. During June headline, consumer inflation fell to 5.1% year on year. That's from 5.2% the previous month, as food and transport costs cooled. Inflation has been above 5% since September 2023. The Reserve Bank estimates that inflation will only stabilize at its targeted 4.5% over the next few quarters. Given that the SARB kept its main interest rate at 8.25% last week, that's the highest level since 2009. The repo rate has been at that level for more than a year. Vodacom has reported a 1.5% rise in revenue during the mobile operator's first quarter. That's as service revenue jumped 10% thanks to a strong showing from Egypt. The country has become a star performer for the group. Service revenue there rose 43.7% in local currency terms during the period, and its customer base expanded 6% to 47.4 million. This has helped lackluster growth at home. Service revenue from South Africa rose 1.8%. Primary Health Properties has posted a 2.9% rise in interim adjusted earnings per share. The UK REIT CEO Mark Davies has described the performance as robust. A dividend per share of 3.45 pence has been declared. This reflects growth of 3%. Looking ahead, PHP is approaching its 30-year anniversary of continuous dividend growth, and so the company says its focus is on driving further earnings growth. AECI's flagged lower half-year profit. The mining and chemicals company says it showed resilience amid declining commodity prices, supply chain disruptions and macroeconomic slowdown. But one-off events led to unusually high operating costs, and it's therefore warned of a headline earnings slump of up to 60%. AECI shares took a knock following that news and declined over 10%. But it's optimistic that the pain will be short-lived and says the full-year earnings outlook remains positive as it expects a stronger second-half performance and a reduction in one-off costs. MTN is looking to increase its network coverage. Africa's largest mobile operator is eyeing the use of satellites. The firm says the lower cost and faster speeds of satellites have increased the attractiveness of the technology for the company. Baldwin plans to expand its rental portfolio. The specialist residential property developer says it will undertake 7,300 apartments for rental over the next 8 to 10 years. The firm has identified existing land parcels owned by the group that will support the move. The land parcels are in Johannesburg, Tshwane and the Western Cape and represent 20% of the company's current unused land portfolio. The rollout of the rental portfolio through its subsidiary Baldwin Rentals will create 39,000 direct and indirect job opportunities over time.
What it means for Baldwin is a step in the right direction. We promised people when we listed we're going to do rentals. We've always had Baldwin Rentals, Pty Limited. We're doing it. We want to help the people of South Africa get into housing. We also think it's a fantastic asset class. When interest rates are high, that we've got a rental business. We also want to help people get into good quality housing and use it as an incubation hub. We can educate people about property. With the history of this country, we need people into good property. And then we also want to try and teach people and help people to buy homes. So you can come and rent from Baldwin for a period, then you can buy from our developments in other places and move along in life and enrich yourself and do well. And we believe we're making a difference in this country.
And RACM and Calibre will change its name. The firm will be known as Gold Rush. The company says the move reflects its largest investment, that being a 59.4% holding in Gold Rush, which is South Africa's largest independent alternative gaming group, whose activities span electronic bingo and retail sports betting. The name change will take effect on August the 14th. Further afield, Deutsche Bank and BNP Paribas beat earning forecasts, but both banks saw their shares slide as investors dug into the earnings numbers. Here's more detail in this package report.
Two of Europe's biggest banks beat forecasts, but still managed to upset investors. Deutsche Bank posted a smaller than expected loss, but it set aside around $1.4 billion for an investor lawsuit, with the move scuppering plans for a share buyback. That saw shares in the bank tumble in early trades. The loss also ended a streak of 15 profitable quarters. But Chief Executive Christian Saving was unworried. In a note to staff, he said the loss was solely due to the legal provision and the bank was on track to hit its goals. France's BNP Paribas also beat forecasts. The Eurozone's biggest bank saw net income jump by over a fifth to nearly $3.7 billion. That marked its best ever second quarter. But there too, shares fell from the open. Investors were dismayed by a big drop in net interest income, the difference between what the bank earns on loans and what it pays on deposits. One analyst said the numbers suggest a poor performance for the lender's retail operations in France and elsewhere.
And troubles between Ukraine and Russia have intensified. Let's cross over to our reporter Darling Lechela for more. Darling.
That's right, Zinati. Hungary and Slovakia have asked the EU to mediate with Ukraine after Kyiv placed Russian energy company Lukoil on a sanctions list. And joining me now with more is DW correspondent Chiponda Chimbelu. Thanks for your time today. Now let's get things started. Just bring us up to speed with what's going on that front.
Thanks for having me. Well, despite EU sanctions against Russia, there are still exemptions for some exports, including crude oil and gas. And some pipelines actually go through Ukraine, which Russia, of course, is still waging a war against. So perhaps it is not surprising that Kyiv adopted sanctions blocking the transit of crude oil sold by the biggest private Russian oil firm, Lukoil, despite an agreement with the EU. Now, Hungary relies on Russia for 70% of its oil imports, and Lukoil accounts for half of that. So there are concerns about energy security in the country. In Slovakia, the main oil refinery is supplied by Lukoil. So this could be political. Hungary and Slovakia are actually considered to be the most pro-Russian EU countries. And whether this is a calculated move by Kyiv to put pressure on those countries remains to be seen. The EU has said it is ready to mediate between the affected countries and Kyiv.
So are EU countries failing to reduce their dependence on Russian energy exports?
That is a question that can only be answered with both a yes and a no. Germany, for instance, has been able to wean itself off of Russian gas imports. Now, the issue appears to be with the exemptions for some energy exports, while Hungary has actually increased its Russian crude oil imports after Russia's full-scale invasion of Ukraine in 2022. Another EU country, Bulgaria, has been able to reduce its dependence on Russian oil imports to zero in that same period. Now, that is because, of course, there was an expiration date on the exemption that allowed Bulgaria to import Russian crude oil. And the government was forced to find an alternative. Kazakhstan is now Bulgaria's main oil supplier. So these exemptions require expiration dates to force governments to act. Still, despite that, it's important to remember that even with sanctions, Russian energy products are still making it to EU countries, both legally and illegally.
I guess the next question to ask here is whether EU sanctions are actually working.
Well, Russia has been able to export crude oil to countries like India, China, and Turkey, and these countries have been able to refine the oil and export it to European countries as jet oil, for instance. The Kremlin has also been using Western vessels to circumvent the $60 oil price cap. Now, that allows it to sell crude at a higher price than the limit set by G7 countries. So Russia has still been able to raise funds for its war chest. In fact, one study shows that the Kremlin has earned 700 billion euros from the export of fossil fuels since the start of the full-scale invasion of Ukraine in early 2022. But the sanctions have, of course, been able to have an effect. They may have cut Russian fossil fuel exports by 12%, according to one estimate. So the answer is the sanctions are working, but not as much as they could. And experts say that if some of the loopholes were closed and the West made it harder for Russia to evade sanctions on energy exports, the effect would even be more than what it currently is.
Chiponda, thanks for your time and those insights. So that was Chiponda Chimbelu from Deutsche Welle. It's back to Zinati now with your markets.